This is Money Talk on News Talk 580 CFRA. Here is John Budden.
Good afternoon, folks. Welcome to today's Money Talk. We start with Tom Peckloff of the Ottawa Business Journal, then go to Kevin O'Leary, who will give his thoughts on the recent economic numbers, then to Matt Hendricks and Eric Sprott of Sprott Asset Management. After the news, to David Prince, who is the founder of Harbinger Capital Research, and back to Kevin O'Leary, who will give his opinion on what the millennials think of the housing market. And we conclude today's show with my interview with Robert Lloyd George, who is Chief Investment Officer at Lloyd George Advisory in Hong Kong. But first, to Tom Peckloff. It's that time again. I'm joined by Tom Peckloff of the Ottawa Business Journal. How are you, Tom?
I'm doing well, John. How are you?
Good, thank you. Tom, we had big news in retail, in culture, and, of course, in hockey this week.
Yeah, that's right, John, and that's where we'll start. But, of course, the plan to develop LeBreton Flats is more than just about hockey, but still the central location of the proposed arena within the development was one of the things that attracted the NCC Evaluation Committee, which did select Eugene Melnick's group, Rendezvous LeBreton's bid for the development plan. They will now enter into negotiations. But, of course, if those happen to fail, the NCC is also happy with the competing bid from DCDSL. Now, back to the arena for a minute. The committee also liked the accessible green roof. They said the whole building was architecturally impressive, and they were also pleased with the LEED Gold designation that it will have. Several other of the buildings along the development will have that LEED Gold designation as well. The committee also liked the affordable housing that was proposed as part of the 4,400 residential units, and they thought that the 5 residential neighborhoods were well spread out within the development design. Now, the negotiation phase promises to be lengthy and very complex, according to NCC officials, and will probably take more time than originally thought, although there was no direct answer given to Ottawa Mayor Jim Watson when he asked whether the shovels will be in the ground in 2018 or 2019. He's now officially a non-voting member of the NCC board, and he says, he never actually came out in support of a bid before the announcement was made, but he said he supported the Senators' bid all along. He says it only makes sense to bring an arena into the downtown core. That's what's happening all across North America nowadays. But even so, hockey politics was not involved in the decision, according to NCC CEO Mark Christensen, who was on the evaluation committee. He said the decision was about city building.
What was the big retail news, Tom?
Well, speculation was going on for some time, but it's now confirmed that Costco will be moving its East End location to Shoppers City East, part of a whole redesign of that mall. Trinity Development Group says a public meeting to discuss the proposal will be held at Earl Armstrong Arena on May 5th. The warehouse retailer, East End store, currently is on Sayreville at Innis, but a lot of people happy with that location because of a lack of parking. In fact, it only has 2 entrances and 1 exit, and the exit often needs the police to direct traffic to get you out of there. Now, Costco has yet to formally sign a lease, and there is no completion date for its relocation. Trinity Senior Development Manager Ryan Moore said that Trinity plans to submit its site plan application to the city in mid-May. Says the 209,000 square foot mall complex will also include a beer store, a Gabriel Pizza, and a Shoppers Drug Mart.
And festival season is fast approaching.
Yeah, that it is, John, and the provincial government has announced this week a $2.2 million boost for 25 Ottawa festivals for 2016. Money coming out of the Celebrate Ontario program. Ottawa Festival's chair, Sean Wilson, says it's a real good news story for the city. He gives the province a lot of credit, too, saying this program, the Celebrate Ontario program, is the only one he knows of that recognizes the important industry the festival industry is. And he says that it's important to support the knowledge economy and support quality of life, good jobs, and celebrate community. Now, for every dollar that he says the festivals in Ottawa get from the province, the individual members turn that into anywhere from $9 to $15 for the economy. So, according to Mr. Wilson, he thinks that's a pretty solid return on investment. In fact, in his words, it's amazing. He says there are serious issues, though, with municipal support. Now, the city unanimously approved an arts investment strategy that was meant to be a 6-year program to get municipal funding up to average levels. 4 years in, the city is $4 million short of its target. Mr. Wilson says he will continue lobbying and reminding the city that there's more than just 2017 celebrations to think about. He says it's important to strengthen and support the festivals and events that have been here for many, many years and will be here long after the anniversary year is over.
And what's on the OBJ radar for this week?
Well, it's another busy week. John, Invest Ottawa is holding its Accelerate Ott conference on May 5th. Same day as Startup Canada is holding Startup Day on the Hill. That's probably not a great scheduling idea, but that's how it's going to play out. The earnings reports are also coming from Shopify, SBL, Kinaxis, and Halogen this week, and a report will also be released that details the struggles women entrepreneurs face at getting funding.
Excellent update. Thank you so much, and we'll talk again the same time next week.
Sounds good, John.
And now to Kevin O'Leary.
Let's stay with BNN Top Line right now. Canada's latest GDP reading comes in better than expected. Joining us for some perspective on how Canada and the investment outlook is right now, we've got Kevin O'Leary standing by. He's chairman of O'Leary Financial Group. Kevin, good to be with you today. And what a nice surprise, wasn't it?
It's absolutely fantastic news, and it tells me one of two things. Either Morneau doesn't know what he's doing with accounting, or he lied to me. Pick one. That's what I want to know, because this government has absolutely zero mandate to plunge this country into $113 billion of deficit with this data. So we've got a really interesting debate about to happen in our country. We don't need deficit spending. We don't need to waste our money, and they didn't tell us the truth. They told us $10 billion in the hole. They lied.
Wow.
Imagine that, a politician lying. I can't believe it. I can't believe it. I'm so shocked. That's never happened before.
Well, but, Kevin, how do you take such a positive and make it a negative?
Look, what they tried to do, and every government does this, they come in, they open the kitchen, they say, my goodness, it's much worse. The last government bankrupted us. We're billions of offside. They made a huge mistake. We have to do everything differently now. Thank goodness you've elected us. We caught these guys with their hands in a cookie jar. We are not in a situation where we need to spend $100 billion. We don't need to plunge ourselves in deficit. We're doing much better, and it's not their business. They haven't spent a dime yet. This is the legacy from the Conservatives. We owe this to Harper. He actually did a pretty good job. And now, as a country, we should take this into account, just like any family would in Canada, and say, wait a minute, what are we spending $113 billion for? Why do we need to do that? Let the economy do its own work in the private sector. Let it continue to grow. This is way better than anybody thought, and now we have the wrong government in place. We need a fiscally responsible government, not this one.
Well, Kevin, are we jumping the gun a little bit in the sense that you always talk about this $113 billion deficit, and I've said to you in the past that we are not there yet, and that I would believe that the government is going to look at the data today and also as we go forward and therefore assess and reassess how much deficit spending is actually needed. We know we're going to have some deficit spending this year, maybe next year. I don't think that we're going to get to $113 billion. I think it's overstating the situation.
I'm not a skeptic like you. I believe my politicians when they tell me what's going to happen. I trust every word they say. And when they tell me I'm going to $113 billion in deficit, I believe them. Now, you're obviously more mature at this, and you've seen them lie to you before, but I'm a neophyte. I'm shocked. I actually here and I wept a tear. I now believe I've been lied to. I'm stunned.
It is a little bit stunning, but let's see how it all plays out.
My heart is broken. I can't believe a politician wouldn't tell me the truth, Catherine. Help me.
Wouldn't you rather them err? You know what they did is what we call on Bay Street and Wall Street, under promise and over deliver.
Look, he can't take any credit for this.
I agree.
The government did not deliver this surprise upside. And now that we have it, let's not blow our brains out with deficit spending. I want transparency. I want to know where we're spending this money, both provincially, every province, every federal dime that's being spent. Talk to me. It's my money. I want to know what they're doing with it and why we have to plunge our country into a massive deficit spending when clearly we're not anywhere near the troubled situation they painted.
We're not.
I'm telling you the truth. They've got to speak. So you make sure when you talk to them, because I'm trusting you to do this, ask them why, again, I have to spend $113 billion. Uncle Kevin is asking. He wants to know.
Folks, we'll go to a break, and when we come back, Matt Hendricks, followed by Eric Sprott, the founder of Sprott Asset Management. Stay with us. This is 580 CFRA.
You're listening to Money Talk on News Talk 580 CFRA.
I'm joined this afternoon by Matt Hendricks, who is Senior Vice President, National Sales at Sprott Asset Management. How are you this weekend, Matt?
Very good, John. Very good, thank you.
Well, we may be getting to spring somewhere along here.
Yeah, the sun's been shining the last week and a half, and I don't think we're going to get any more snow, but it's really nice to get some warmer weather.
Well, the way I'd like to start off today is to ask you why the term non-correlated is so important to people who are building a portfolio.
Well, John, I mean, building a diversified portfolio that is non-correlated is very important because it's like basically having all your eggs in one basket. If you're all in equities and the equities go up, that's great, but if the equities go down, then you get clobbered. If you're all fixed income, the same thing happens. If fixed income's in favor, you do well. If not, it does not do well. And, you know, what we've learned over the years is you want to have a portfolio that has exposure to 4 or 5 different sectors that are what we call non-correlated. So if the equities go up, then the equity portion of your portfolio goes up. The basic reason is if one sector, the main sector, which is basically happening this last month, where the month of April, the broad markets have really done nothing. If you have a sleeve of, say, gold, or a sleeve of energy, or a sleeve of alternative income, or a sleeve of timber, or a sleeve of infrastructure, which is non-correlated to your bank stocks and your material stocks and your consumer discretionary stocks, then your portfolio has a chance to earn some returns while the core does nothing.
As an example, if you had a sleeve of 10% of oil and 10% of precious metals during the past 3 months, you've had a tremendous rise that compensates you for the quiet time in the core assets in the portfolio.
Oh, well, definitely. So, you know, as of yesterday, the Toronto stock market is up, let's call it 6%. The New York Dow Jones is up 2. The S&P 500 is up 2. The gold index is up 65. The energy index is up 20. The silver index is up 80. Infrastructure is up. So, yeah, so that's these sleeves, these non-correlated sleeves are sort of the engine driving a portfolio right now. But we always want to maintain that the core is the biggest part of your portfolio and that these sleeves should be, as we say, sleeves, call it 5 or 10% of the portfolio.
Now, you have a flow-through issue that is still available to investors, and I think it's a good idea to tell our listeners about it because it's a fabulous tax advantage for a lot of people.
Well, definitely, John. So once again, a flow-through fund is, first and foremost, is a tax deduction. So dollar for dollar, what you invest in this, you get to deduct off your 2016 income tax. It goes into a resource-based investment for 1 year at Sprott. And again, the way that the oil and gold stocks are performing, you know, we certainly believe that this year's vintage is going to be quite lucrative. But more importantly, if you have a very big T4, like if you T4, I like to say at over 200,000, this is a way to get money back from the government. And with the new government in town, the highest income earners are paying 5% more income tax, and it's never been a better idea to be buying flow-through and to save yourself some money in tax.
I thought this week that I would replay the interview that I did about a month ago with Eric Sprott. Given the performance of precious metals in the past week, and we're on the edge of breaking through $1,300 US an ounce on gold.
For sure, John. The reasons to own precious metals have never been better. We have the U.S. dollar breaking down. The Bank of Japan did not act the way the market wanted it to act on Thursday, which caused some turmoil and caused a lot of money to go into gold. It's a historical store of wealth. It's a hedge against inflation. It's a hedge against the U.S. dollar. Supply and demand metrics have never been better. And these gold stocks have been beaten up massively since 2011, and it's time for them to rebound.
Matt, could you give our listeners and advisors your coordinates should they want to get in touch with you?
For sure, John. I'm always reachable toll-free at 1-866-299-9906. And don't forget to visit Sprott.com.
Thank you. Take care.
You too, John.
And now to Eric Sprott.
Hey, John. Great to be with you again.
Well, it appears that the secular bull market in gold is back on the track.
It would certainly seem that way. There's all sorts of indicators of that. Probably the most obvious one is the gold stocks are up something like 67% since January 19th this year. Price of gold is up almost $200. There's a lot of money pouring into the physical gold ETFs. We've had a number of major commercial banks, amongst the big 10 in the world, sort of changing their tune on gold, where various, either the technical analysts or the gold analyst is suggesting we might see a lot of things changing. And, of course, we have lots of economic things, whether it's the economy going down, the zero interest rates, negative interest rates, the suggestion that people shouldn't be allowed to have cash, all of which are making people think more clearly about where everything's headed.
Now, what are the ramifications of the central bank's dangerous negative interest rate experiment?
Well, John, it's interesting. You can see, for example, I saw a data point out of Japan that you can't buy a safe anymore, to store gold in your house because they're all sold. I hear that the demand for, I think it's 10,000 yen notes has gone off the end. Everyone's buying their notes to take the money out of the bank. You store it somewhere at home. I mean, the obvious thing is if you really have negative interest rates, so you leave your money in a bank, which is a highly levered financial institution, and you're just an unsecured creditor, and they say at the end of the year that, the $10,000 you have in there is worth less than $10,000 at the end of the year. Well, why would you leave it in there when you're taking all that risk? So people obviously should take their money out of the bank. There's no sense taking on the risk of the bank. It's a very levered financial institution. And, of course, the next thing you wonder about is, well, is it better to own the paper or the gold? Of course, you and I would both agree it's always been better to own the physical asset rather than the paper asset. So I think it brings people into the precious metals markets for certain with negative interest rates.
Is the well-advertised recovery in the U.S. economy since 2008 just a mirage?
Well, John, I happen to think it's bogus. And whether you look at housing starts or, Caterpillar sales that have gone down for 34 months, or like Class 8 truck sales were down 58% last month, the consumer confidence is plunging, the ISM service index is in contraction mode. I mean, there's so many data points throughout the world. Probably the most notable one, though, is when you go to Japan and South Korea and China, you look at the export and import numbers. I mean, they're all down double digits. And that's not just a little recession, by the way. That might be qualified as a depression. So I think all of what's been done here over the last decade, I'll refer mostly to the U.S., but, subsequent to the NASDAQ crash and the financial crisis in 2008, the powers that be have done everything they can do to try to sustain the economy, and they sustain it by these zero interest rates, which lets people buy houses who can't afford houses, much as they did in 07, 08, lets people buy cars who can't afford to buy cars. So you bring all this consumption forward, and you still bumble along at 1 to 2% growth. We've run out of arrows here now. We can't reduce rates anymore. We can't bring any more people in. The debts of all countries have exploded here. So, yeah, they've kind of held it together. But as you know, in the Austrian school, when you create economic growth by creating debt, someday the debt has to shrink because you have to service the debt. And I think it's all been a mirage. You look at some of the earnings releases and the outlooks of the various CEOs in various industries, the oil crash, the non-precious metals crash. It all leads to one thing, and that is problems down the line here. So I've never been a believer in most of the government data. I don't believe that the unemployment rates are really 4.9%. I think that many people have had to take multiple jobs now because most companies only want to hire you for 29 and a half weeks. So you get a guy taking 2 jobs. It sounds like we created a job, but it's a lousy job, and the good jobs are disappearing. I've never been a believer in the whole monetary policy that thinks it can cause the economy to strengthen when it's really been weak for a long time and now probably going negative.
Has global banking become the biggest Ponzi scheme, i.e., if depositors want their money back all at once from banks like Deutsche Bank, they may be in for a Lehman surprise?
Well, of course, the problem with the whole banking system is, they borrow short, and borrowing short means you have a depositor who thinks he can get his money out the next day, but you're lending long. You're lending against a house mortgage that lasts for 30 years or a car loan that lasts for 7 or 8 years now, and the depositor says, I'd like to get my money out. Well, now you got to sell an asset in order to get the cash to pay the depositor back, except there's no market for the asset. And or you'll knock the price of the assets down. You have to sell stocks or bonds, or tell a guy, you want his mortgage paid, he's got to sell his house. So the fact that these institutions are so levered, they borrow so short and lend so long, it just creates a whole problem that we had in 07, 08, when I would remind all your listeners, all the banks were effectively broke. And people should realize that. They were broke in 07, 08. They were bailed out by the various governments. But the reality is when you're levered 20 to 1 or 30 to 1, it doesn't take much of a decline in the left-hand side of your balance sheet, the asset side. If you lose 3 to 5%, you have no capital. And I think we're seeing signs of that stress when you look at what some of these bank stocks have done Deutsche Bank being the poster boy these days. But even the banks, I think RBS came out, Royal Bank of Scotland came out, reported a loss. Standard Chartered had a loss. There was one other major loss of the European bank. HSBC, I think it was, yeah. You know, they're having trouble putting it together. Of course, negative interest rates, the spread of the bank are going down. Earnings are going to go down. JP Morgan announced their trading revenues in the first quarter down 25%. So these banks are very, very risky. I've always believed that. And when people start worrying about having money in banks, that's when gold and silver get going.
Has the $1 quadrillion derivatives monster magically gone away?
Well, I mean, I just find it totally ridiculous that they have all these derivatives, and the funny part is most of the derivatives are held by four institutions who just seem to trade with themselves. For what purpose, I have no idea. But no, it hasn't gone away. When you think of a quadrillion, which is a pretty big number to think about, John, I mean, it doesn't take much of a decline on a quadrillion. The bank capital in the world might be, I don't even know if it's $2 trillion. So, you know, you get a 2% decline in assets underlying the derivatives, and all the bank capital is wiped out in a day. And we've seen such volatility in currencies and stock markets and bonds, whether, you know, you might be short government bonds, you're getting wiped out. You might be long triple Cs, you're getting wiped out. I mean, there's so much volatility out there that to imagine that these derivatives haven't suffered losses. Somebody's suffering losses here. And, of course, what happens is the guy with the loss can't pay. And so the guy who thinks he's got the gain is not going to receive it because the losses become staggering. And, of course, again, the poster boy is Deutsche Bank, that I think has something like 60 to 70 trillion of derivatives. And I think their shareholders' equity is something like 300 billion. So, and I might have overstated that a lot. It could be as little as 60 billion. So it just takes nothing to wipe them out.
We'll go to the news, and when we come back, David Prince and Kevin O'Leary.
Folks, stay with us. You're listening to 580 CFRA.
Now back to Money Talk on News Talk 580 CFRA.
The Canadian economy contracted in February, not as much as expected. It actually briefly pushed the Canadian dollar above the 80-cent U.S. mark. For more on the economy and what's next for our loonie, we get perspective from Harbinger Capital Markets' David Prince. Good to have you with us again.
Nice to be here, especially on a day like this.
Why is that?
Well, you have another one of those glorious reports which seems to contradict an awful lot of the theory that we were in dire straits and everything's terrible, and now what are we going to do?
So February, we saw the economy shrink by 0.1%. Economists, the dismal scientists, told us to expect 0.2%. So, yay.
Yeah. Well, I think the bigger issue that came out today was the fact that obviously we've got better collecting abilities in terms of the taxes, but more to the point, here we are running a surplus at the federal level, and that is actually very encouraging for anybody who is a foreign investor looking at the situation. So one of two things have got to happen. Obviously, Mr. Trudeau is going to spend like mad over the month of March because he wants it not to be balanced, to be in a deficit. Or, in fact, the numbers were right all along that we were going to be able to collect, and the economy wasn't as bad in terms of the non-resource sector as what was thought. There's a lot of things in that GDP report. I'm going to be brief if I can about it. One of the key things is its February numbers. It had a big kick from retail sales. We talked about this last week. Mm-hmm. The retail sales number definitely improved because we had a lot of cross-border shopping. And we also had the advantage that the prices for a lot of people in Canada were discounted because we had a lot of inventory that was very much part of that sales. That said, what we're dealing with now is we've got weakness again in the number in manufacturing. Mm-hmm. The pickup that Ms. Wynne and company all looked for, a big pickup in manufacturing, has not materialized. Now we have the dollar back above where it was last July, and that's non-competitive.
In the weakness in the U.S. dollar, strength in crude oil playing a role in that, and we've seen a bit of a disconnect between that and our sort of counterpart in the resources world, the Australian dollar.
You make a really good point, and I think this is something that people have overlooked this week. There's no doubt that there was a great short position in a number of commodity. We talked about this last week. Mm-hmm. But what's very interesting is this week we kept seeing the rise in the oil price. We ran into a little trouble in the last day in this region, no surprise. Mm-hmm. But the Canadian dollar has already had a massive upward move. It continued that move on the report earlier today. But all this week, we've not seen a follow-through in Australia, which is even more attached to resources on the economy than what we are.
But they're more so attached to China. We're
True.
more attached to the United States.
So what's been rising this week? All the ones that have been attached to China as well. So we've seen a big lift-off in price. For example, today we got it in copper. Mm-hmm. So the realization that we're dealing with this U.S. dollar that has fallen and rolled over, it kind of makes me laugh. If things are so great in the United States, why suddenly are we seeing such a rollover? Mm. There may be some of this confusion coming from the election outcome in the States. That may be taking hold. But quite frankly, it looks like a bunch of people are running scared. They're short and they've been hurt badly. We are seeing an awful lot of hedge fund redemption. But the bigger issue that I'm told that makes sense is that there's been a lot more mutual fund redemption.
The cheap money ride continues in the United States. We saw a run on gold to a degree. Any chance we're going to turn $1,300 into support? We don't seem to have it yet.
Well, going back to what I said at the beginning of the year, one of the things that we always see in gold is a seasonal trade. Mm-hmm. And the seasonal trade usually peaks out somewhere around the end of February, beginning of March. Okay. But this year I said we could see it because of negative rates. We could see it carry on. And in fact, that's precisely what's happened. Gold has gotten significantly above other commodity prices. There's no doubt that we've seen a pickup on a relative basis of silver to gold. You're starting to see it today with copper to gold. So you are seeing that weakness in the U.S. dollar being translated into stronger pricing in U.S. dollar terms for other commodities. My fear about this is it's too soon and it's too far and too fast. So don't be surprised that we get whipped around here quite a bit in terms of pricing because the U.S. dollar, well, it's had a pretty nasty decline. Don't be surprised that we start to see some reversals come into May.
Now back to Kevin O'Leary and his thoughts on how the millennials view the real estate market.
We've been discussing a new survey from the Bank of Montreal showing that 70% of millennials are delaying home ownership. Just what does this tell us about housing affordability and the impact that this is having on younger Canadians? Kevin O'Leary is joining us now with his take. Kevin, what is this telling us? And the context is important as well. If they'd done this 6 years ago, what would the number be?
Look, it's a smart move on their behalf. You think about what asset class has not had a correction in 21 years. It's housing. What asset class is very sensitive to rising rates should they rise? Mm-hmm. It's housing. What asset class has very, very high transaction costs? It's housing, as much as 12%. By the time you pay the agents and you also pay the land transfer taxes, insurance fees, home inspection fees, this is not an exciting asset class if you're a millennial, particularly if you don't need to keep it for 36 months. Most people are very, very mobile in their jobs. And so today the trend is, and there's some buildings being built in Calgary, Vancouver, in Toronto, actually very close to these studios, called micro suites. 600 square feet, 3-bedroom. Think about that.
I think it makes sense.
So you basically sleep like a bat hanging from the ceiling. You use the kitchen sink.
That makes
sense. You think about it. 3 bedrooms and 600 square feet. That means your kitchen sink's also your toilet. That's the assumption I'm going to make. But it doesn't matter. These units are all for rent.
Yeah, but Kevin, you know what? My first apartment in Chicago was 800 square feet.
That's a palace now. That's a palace.
I slept on a couch for 2 years.
Yeah, so? My point is, why buy that when you can rent it? But what's great about millennials is they're saying, why should I go in debt? Why don't I get something close enough to work that I can walk there? What do I need a car for? I'll Uber. There's a huge why do I need to own it and be in debt strategy that is very interesting.
Well, only because some of those studio apartments, as they used to be called, actually do increase in value, assuming that there's another generation coming up that needs someplace to live. That's why. And you can rent that out.
The reason I know this is somebody approached me about buying some of them for the portfolio on a speculative basis. And I looked at the layout and I said, this is a little rat hole. Like, who would ever want to own this? He said, you don't forget about it. You just rent it to everybody for $1,600 a month. You pack in 3 people into 600 square feet. That's coming.
You're not putting three
There's
people
3 bedrooms, 600 square feet, right next door to this studio.
I want to, you know what, we'll go to a field shoot because I want to see
Absolutely. That. It's holding the ground right now, but they're trying to sell the units. We should go field shoot. I want to see
Let's look at the
I want to see you sleep hanging from the ceiling.
Oh my God.
You're a vampire.
It's not bad. I do not think it's that bad.
The trend is, I've got a whole bunch of them working for me right close to here. Ask any of them. Ask any of my staff in their 20s. Why should I be in debt? What do I need a car for? Why don't I just walk to work? I'll just rent everything. And that is the trend, and I think they're smart.
But do you think that that's just something that we're seeing right now because full-time jobs are hard to come by, because the housing affordability is so low, and that this is just a point in time and that we'll get past this? Or are there going to be longer-term repercussions for the economy and maybe for this generation?
I think there's a new attitude, perhaps going through the shock of 07, 08, 09. Yeah. Why should I risk my net worth in debt? What do I need a mortgage for in the first place? Why is there guarantee that it's going to go up in value?
Because home equity value over the long term is viewed as going up.
The only reason that happened without a correction in 21 years is rates did nothing else except go down. If rates go up...
What about the immigration demand?
Well, that's also important. There's no question about it. The question is, all pockets aren't the same now. Look at Calgary and the chaos going on out there and the collapse of the economy there and the complete incompetence of that government. People are really losing money in real estate now. There's no demand for a shoebox condo there. Everybody's leaving the province. They're losing jobs by the hundreds of thousands. So that's not a good place to invest in real estate. Vancouver is age in demand. Toronto is all the millennials moving downtown, so they don't want to live in the burbs. They don't want to take any public transportation. And frankly, I think that trend remains. The question is, can you get someone to sign a mortgage anymore? Ask the millennials working in my office, and their answer is, hell no.
Really?
What do I want debt for?
Because they want to see some type of appreciation, and they can do that and live there as opposed to just paying rent, having money going out the door.
I don't think real estate's a good asset class in the next 5 years. I think at best it's flat.
But you know what, Kevin, just going back for one moment, when you think about where millennials are going to be living, like why not, to your point about using Uber, not wanting to take public transportation, wanting to walk everywhere, why not just have a tiny little apartment or condo? And, they're going to be out all the time anyway. I mean,
buy it?
Buy it, yeah.
Because the windows are going to fall out of these places in the next 8 years. This is all crap. Are you kidding?
Because
my personal opinion of the stuff that's going up in downtown cores, the shoebox condos, is garbage. That stuff will have to have a new skin every 15 to 20 years, and you're going to have to pay for the cost. These glass skin garbage units...
Glass skin garbage.
You have to change the windows in 20 years. I wouldn't touch this stuff with a 10-foot pole. It's a personal opinion. I'm not trying to dump on the real estate guys. No. This stuff is garbage.
I think that a lot of people, if you looked at the quality, would definitely be questioning it. There's no doubt about it. And then you've got the condo fees associated with it and all the repairs. You're right. I know.
It's just a shoebox unit. You rent it. It's like a Japanese tube you sleep in a train station. Same thing. I don't get why you want to own it. Just let somebody else own it and rent it from them.
Because you would assume that somebody else is going to come up right behind you and need to rent a place.
What?
That's why.
A shoebox condo?
Yes.
No, I don't think so. A rat hole is a rat hole forever, Catherine.
We're going to a break, and when we come back, my interview with Robert Lloyd George, Chairman and Chief Investment Officer of Lloyd George Advisory in Hong Kong. Stay with us, folks. You are listening to 580 CFRA.
You're listening to Money Talk on News Talk 580 CFRA.
Well, it's a great pleasure to welcome Robert Lloyd George to Money Talk. Robert is the Chief Investment Officer of Lloyd George Advisory based in Hong Kong. How are you, Robert?
Fine, thank you, John. It's nice to talk to you again.
Well, I'm wanting to check with you based on your April 16th investment outlook. And the title, of course, was Could Inflation Return? So let's start with that, the prospect of inflation returning after we've been thoroughly convinced that we're in a deflationary environment.
Right. Well, I mean, it is always and everywhere the most important question for investors. Are we facing deflation or inflation? And the last 2 years, anyway, we've been seeing this quite dramatic drop in commodity prices, notably oil, and then we've had negative interest rates starting in Japan and Europe, and everyone kind of thought inflation is dead and buried, and despite all the money printing around the world, it doesn't seem to be working. Well, I just asked the question in my April outlook because I think that, first of all, with the recovery of the oil price from a low of $26 in February, now trading about $20 above that, around $45, some other commodity prices coming up. Economic activity continues to be subdued, but the economy is growing, and also wages are beginning to rise, and we've seen a political move, I think, both in the States and in the UK and some other places, to raise the minimum wage by around 50%. So I think that's interesting because we've been through this long period of economic divergence and the 1% and all that, and maybe we're going back into a political period when there is more support for the share of labor in profits. So that seems to me an important long-term trend, and I know you're a follower of Kondratiev, and I think these trends are very important to follow. So I think that if inflation would surprise investors by the end of this year and rise to 3 or even 4%, that would change everything. And I think we have to think about it as a possibility. I'm not really ready to predict it. But I think that, we could see interest rates back to a normal level. We could see corrections in some of the bubble markets, notably property, and of course bond markets would be hit. But I think that it's going to be a very volatile year. As Dean LeBaron said, if you don't know what's happening, best to say you don't know. Well, I don't know for sure, but I'm just considering different scenarios, Well,
let's do a rundown of the countries that you pay attention to, and we'll start with China. What is your attitude towards the Chinese market? Are you moving away from it, or are you moving more money into the Chinese market right now?
Well, I met with George Soros in January, and he was very much in the headlines as shorting the Chinese currency, the renminbi, and predicting that China with 300% debt to GDP would collapse. And I said to him, George, I'm sure you're right in your analysis, but I think the timing is very difficult, and I don't believe this is the right time. And here we are 3 months later. And what has happened is that the Chinese have pulled out all the stops again, and their total social financing is up to something like 25% year on year. The infrastructure spending is booming again. They're building 23,000 kilometers of new railways and 50,000 kilometers of new gas pipelines, to give you an instance. I mean, they are pumping money into their economy. They have stabilized the renminbi and held it very stable, really, for the last 2 or 3 months. Their residential property market has picked up strongly. This is a genuine surprise for me, because I've been expecting a correction in property in China. So I think what it teaches us is that the cycles in China are different, and they can go on for much longer than we expect from a Western analysis. And I think that may have been a year too early, but I'm sure that at some point the economic cycle is going to catch up with China, and they're going to have a significant correction in their property market, in their currency, and in their stock market. But it's not today or next quarter. And of course that also affects Hong Kong. Hong Kong has been somewhat squeezed by the cutback in luxury spending by the Chinese, the reduction in tourism and visitors to Hong Kong, and the high property and wage rates in Hong Kong, which are now beginning to correct. The rents are beginning to weaken. So we are actually quite cautious on the outlook for Hong Kong. And for China, I think we are also cautious, but again, it's a question of timing.
Your favored destination for money is India these days, and what are your thoughts on the markets there?
Well, I think I would sum it up by saying, we're in a low-growth world, John. I mean, everywhere we look, things are slowing down in Europe and the States and, of course, Japan and eventually China. But there's always one place where you can make money. And my conviction in the next 2 to 3 years is that will be India. India's got 1.3 billion population. It's going to overtake China sometime in the next 5 or 10 years. Half of them are under 25 years old. They've got tremendous thirst for education, for new technology. They're very good at maths and science. They've got these wonderful Indian Institute of Technologies. They produce a lot of engineers every year. We see Tata Consulting. They hire 50,000 software engineers each year. It's the scale of the thing which is astonishing. And they're 25 years behind China in terms of building out their infrastructure. It's beginning now. And I think they've had now for 2 years a really good pro-business government under Prime Minister Modi. He's not getting the headlines anymore. His honeymoon is over. But actually underneath the surface, there's a cleanup going on. Cleanup of corruption, cleanup of the corrupt corporate sector, and an introduction of greater efficiency. And it's very slow. It's going to take 10 years. But we see it coming through in corporate earnings growth. In India, 20, 25%. Good little companies. We're finding a lot of consumer sector companies growing. They have market cap of about 2 billion. So they're underneath the radar of international investors. And the rupee, very stable. Good central bank, Reserve Bank of India. Inflation's coming down. They've had high real interest rates. That's coming down. So I think the backdrop is good. The companies on the street in India are doing very well. You have to be very selective. We've got a good team on the ground in Bombay, and they help us select some good companies. So I feel this is my one major bet for the next 2 or 3 years. India and its surrounding markets will do the best.
How about other favored regions and a few companies that you would like to single out?
Well, if you look at our 10 biggest positions, we do own some China service sector companies like China Lodging, which is a hotel chain, some of the online businesses like Tencent and Travel Sky, which is, again, a Chinese tourism play. Airports of Thailand, which is growing at about 30%, again, very much driven by tourism from the rest of Asia, notably China. We're rather cautious on the Philippines as a political prospect. They've got an election coming in 2 weeks. But there's one company called Universal Robina, which is an outstanding supermarket and food chain, which is expanding into Southeast Asia, notably into Vietnam. That, I think, is a standout, so we'd own that. And in India, we've got several companies that we really like a Housing Development Finance Corporation, Infosys, the software giant, some smaller companies. I just bought a company which is only $300 million in market cap, but it's very exciting little business. I probably shouldn't say the name at this point because it's so illiquid. But, we're finding some really, really good companies on the ground around Asia. And I think India, notably, is where we're finding the most new names.
And let's have your thoughts on Japan.
Well, Japan is a tough one because we were fairly positive on Japan last year. And, we invested, for example, in KDDI, which is the telecom company. It's done very well. But most of our companies that were export-oriented have been squeezed by the unexpected strength of the yen. And now the Bank of Japan has decided that they've done enough. Well, apparently, they're not going to do any more monetary stimulus. That's caused a bit of a dampener on the market, and the yen has shot up again. So that's squeezing profits. And I think it's going to be harder. I mean, we make money in good domestic plays in Japan with the yen strengthening, but if anything is export-oriented, you're really squeezed at the moment. So I'm a little bit more cautious about Japan going forward. I think it's an interesting market, and a lot of fund managers I know have been overweight there. But, you've got a demographic implosion. You've got a very aging society. You don't need a lot of infrastructure or, building investment. And I think it's difficult to see where the growth of the profit is going to come from.
Well, I'd be remiss if I didn't ask you about U.S. politics and the prospect of Brexit in the UK.
Well, I think, John, that behind everything, investors are looking at the prospect of Donald Trump becoming president, and does he really mean what he says? If he does, then we're going to have protectionism, and people in Asia and Europe are horrified by this prospect. And so that's one risk that people think about. And the other big one, of course, is Brexit. And I think the polls are pretty close. Here in London, most of the people I know who are well-informed in business in the city would like us to stay in the European Union. But I think that when you go out in the country and talk to people, they say, we don't see any point in being ruled by Brussels. We want to be ruled by Westminster, and there's too many immigrants coming in, and there's crime and terrorism and all that. And, there is a strong popular feeling that enough is enough, and we want to get back to our own country. I think the economic damage of a Brexit would be far larger than is generally perceived. I've seen estimates of up to 10% shrinkage of the British GDP. There would be lots of consequences for Europe. I think the Germans would probably say, well, we're not going to pay for everything. If the British are pulling out, then you've got a serious problem with the common agricultural policy. Land values would fall. There would be a crunch time for the Mediterranean countries from France, Italy, Greece, Spain. So I feel very cautious, actually, and I think all investors are sitting on their hands waiting to see what happens in 2 months' time. And if we vote to remain, there'll be a huge sigh of relief and probably a rally. But, the question won't go away. I think the European Union has some serious flaws, and, there are going to be, and a lot of other countries saying, well, the British have a vote, why don't we have a vote? Because there hasn't been really a democratic accountability in the Brussels bureaucracy.
Well, Robert, that's a great update, and we'll look forward to talking to you again next month when your May outlook arrives, and all best, and take care.
Thank you, John. It's a pleasure.
Folks, thanks for joining us this afternoon on Money Talk. We'll be back same time next week, 2 p.m. Sunday. Have a good week. I'm John Budden.